Hi, everyone. Welcome back to the Market Chat. My name is Richard Moglen. Joining me today is one of my favorite follows on Twitter. We've got Chris Perruna, who's an architect, real estate professional, and investor. Chris, thanks so much for being here and welcome to the show.
Richard, thank you. I love your interviews. Pleasure to be here today.
Oh, glad to have you and great to hear that. As I'm sure you know, having watched a few, I always like to start out by asking my guests about their kind of backgrounds and how they get interested in investing. So could you kind of run down a brief history about how you got interested in investing and also kind of your evolution along the way?
Sure. So I first started investing in the late 90s. I actually graduated high school in 96, went on to college. To back up for a moment, my father owned a couple of restaurants when I was younger. And if you imagine, he was working night times, weekends, holidays. So he had his days free for the most part.
Right.
So he would invest during the daytime. And I've mentioned this before online. It was pre-internet. We didn't have certain websites we can go to. So we'd get the newspaper. He would check in the newspaper and he would kind of just share with me when I was probably about 12, 14 years old and inside that range or so. So you're talking probably about early to mid 90s. And he's like, hey, I'm investing in stocks. This is what I do. This is what the stock market is. And I think I'm a very analytical mind when it comes to charts and graphs. And I love stuff with the stock market. I love stuff graphically in my industry, architecture and construction. And I love weather maps as well. So I think just my mind is built in that way. So when he started to teach me about the stock market, I immediately fell in love. I was like, this is awesome. I want to get involved with this. So I used to track the stocks that he was looking into at the time. And the internet was just starting in the mid 90s. And he wasn't quite a growth stock investor. He was more of a traditional investor. But as the 90s kind of went on, he started to get into that a little bit. So as I went to college, E-Trade came out, Ameritrade came out, and there was folks that I was going to school with, and some of them were starting to open up accounts. So I was the first one to raise my hand and said, hey, I want to open up an account. So we did. And that's essentially how I first got started investing in the market. Now, if you imagine the late 90s, you're talking Intel and AOL and Cisco and Oracle and stocks like that. These were the stocks that I was buying back then. Different than the market today. I know the hype today seems to be a lot of what people like to compare to the late 90s. It's definitely a different market. I mean, a lot of the stocks that came out back then was just .com stocks. Right. They didn't have, maybe they had some revenue, but a lot of them were pre-revenue. None of them had profits or earnings or stuff along those lines. But it was a hysteria that happened in the late 90s. I happened to get swept up into it. My roommates started to invest in stocks and we kind of had this little thing in school and we were all just kind of just throwing our money here, throwing our money there. And we all quickly ran our accounts up. So it was fun. And I became immediately addicted based on what my father was showing me previously and then what I was starting to do in college at that point.
Very cool. And definitely from what you've posted on Twitter, your style has certainly changed from back then where you're probably more trading every day, selling every week or so. So talk a little bit about how you've evolved to your kind of current system. And obviously it's kind of matched up with your lifestyle now because you are a full-time professional in another field. So can you talk about kind of how that shift happened and
Sure.
Kind of some learning moments along the way?
100%. So when I was trading in college, you imagine it was in between classes and it wasn't day trading, but it was definitely in and out swings pretty quickly. Yeah. And stocks were moving back then. If I remember correctly, stocks like AOL, they were swinging $100 in a day. And you could literally buy at 10 a.m. in the morning, go to a class or two, come back, cash out. And then the next day we do another swing very similar. And sometimes it would just keep going up. And we were just getting in and out of stocks at that point. Knew nothing about taxes, really didn't care about taxes. We didn't have income back then. So it really didn't matter to us. But fast forward beyond college, and this is where it really starts to kind of work. I ran my account up multiple folds from 98 into about mid 2000 or so. And the one stock that really just daggered through me is Extreme Networks. And there was others, but Extreme Networks was the one that I started to load up into. And I used to buy the dip, buy the dip, buy the dip. And you hear that today, just buy the dip. I kept buying the dip in 99, 2000, and it worked. Well, late 2000 into 2001 and definitely into 2002, that certainly didn't work. And I lost pretty much everything I made in 99, 2000, from 2000 to 2001 or so, and lost it all. So where I really started to formulate myself was from, say, mid 2001. Now, I graduated in 2001, come out of college, and 9/11 happens. And ironically, I was going to Vegas with a couple of friends to kind of celebrate graduation, all that kind of stuff. That happens. The whole world changed. I kind of sat back between 2001, 2002 and said, I want to learn about investing a little bit deeper. My father kind of taught me a couple of things in the fringe, but nothing detailed. He was a moving average guy, and that's something I'll get into later. But I really didn't know what the market was, what investing was, the different styles of investing. So the first thing I did is I went onto the internet at that point and said, where can I seek out education, books, and what will allow me to kind of learn what's truly going on? So from middle 2001 to about 2003, and it's not coincidental, it's just the market started to kind of base at that point. that's where I really filled in my education. Now I was still trading at that point, and I was not trading well, and everything was very, very short term swing trading. So I wasn't really even position trading, and I certainly wasn't trend trading or long term trading at that point. I would make fun of the Warren Buffetts of the world when I'm a young kid, and I say, oh, buy and hold. I'm not buying and holding. I can make a lot more money like this. And I might have had some aspirations at that point to become a full-time trader. But I went into my career, and that just didn't happen. And ultimately, it's a question that's come up recently when you posted something out there. I've gotten on past interviews and even online. Would I want to trade full-time? And I think as I went through this evolution of trading, I wouldn't, because of my lifestyle with what I do for a full-time career, what I do with my family, and cash flow being so important to me with multiple streams of income, whether it be my salary, my wife's salary, real estate rental properties that we have. I do have some dividend stocks. It's not a major portion of my income that comes in, but I have a plan from this point forward, where I am in my early 40s, to go from here in my early 60s or so, to build a stronger real estate portfolio to have that cash flow. So to trade full time, it doesn't fit my mental state as far as what I like to do.
Right.
And B, it would blow away everything else that I'm doing in my life. So it just wouldn't work. I'm not going to sit here and look at a screen all day and trade stocks and drive myself nuts. So my evolution of trading is, as I started to learn about CANSLIM, was the first thing in William O'Neill's How to Make Money in Stocks. That was one of the first books I was pointed to. And I fell in love with the book, and I fell in love with the strategy. Very simplistic, made a lot of sense. And I said, hey, this is the style that I want to trade. So let's take some money and see if it actually works. And in 2003, as we're coming out of that nasty 3-year bear market, it really started to work. And I started to see some appreciation of my net worth at that point, just in my account. And I said, okay, this is what I want to do. But I was swing trading. So probably for the next 10 years or so, I was strictly a swing trader. And a lot of the stocks that have appreciated 50, 100x since then, had I sold, I'd probably be a lot better. Well, no, I would be a lot better off if I just parked a bunch of money in your Apples and your Amazons, your Netflix. But I was swing trading them for a number of different years, and it's just what I enjoyed to do as well. I didn't have any long-term accounts or long-term holdings. It just wasn't anything I was doing at the time. I was always told, hey, get a Roth IRA, get a regular IRA, get anything along those lines, get index funds, and just every month, just throw money into it. But being stubborn, I was like, nope, I can beat the market. I'm going to do better than the market. This is a little bit of a game, and it's a little bit of an intelligent strategy where I say, can I do better than the historical averages? And it's something I just really enjoy doing, is trying to go out and find young, innovative companies and try to outperform the major indexes. What happened in 2020 and has seen accounts go up 100%, 200%, 300%, that's not normal. I think most people know that now, especially in the last month or so. I think if you can get anything from 15 to 25% year over year, you're doing really, really well. And you're above those maybe 6 to 8% historical averages that you can get in an index fund, or if you're just going to buy the main part of the market. So my style over the years has evolved from being a swing trader to, within the last 5 or 6 years, being a little bit of more of a long-term trader and more of a position trend trader.
Right.
Long-term in a long-term account. And it's something maybe we'll talk about today. I haven't talked about a lot online, but I see there's a lot of feedback I'm getting from a lot of folks on my thread, your thread, other threads. Hey, I want to hear more about that long-term account. And it's an account there's not a lot of action in it, but it's an account that has just great brands that we love to own. That's really simply what it is. And stocks that we buy, and then we just kind of park them away, and that's it. Occasionally we'll make some changes when we have to. We'll park that money. But the account I really focus online is the growth account. And that's the account where we're looking for these really exciting, young, innovative companies that are going to change what we're doing today in this world in the next 5 to 10 years. And that's what really excites me. And I think that's what a lot of your listeners and a lot of my followers really like to understand, is where are we going in the future and what can we invest in to kind of capitalize on that? And that's what really gets me going.
No, very cool. Very cool. And you mentioned How to Make Money in Stocks by William O'Neill. Obviously, a lot of my viewers will be familiar with that book. Outside of that book, are there any others that you think are must reads for kind of growth style investing or trading that you think would really help shorten people's learning curves?
I do. So I mentioned one yesterday on my stream, Stan Weinstein's How to Profit in Bull and Bear Markets. I think it's a great book. It's focused more heavily on the technicals, more so than what Bill O'Neill is going to be in his books. But I think it complements How to Make Money in Stocks really well. If you read, whether it be Bill O'Neill or David Ryan or some of the people from Market Wizards, they got into a lot of books like Reminiscence of a Stock Operator is a great book from a psychological standpoint. Martin Zweig has a great book. Marty Schwartz has another good book. Just coming to mind, I'm trying to think. I'm a big Mammoth fan. So if you get into when to sell, nature of risk, when to buy, I think Justin Mammoth has some really good books that really complement How to Make Money in Stocks. And there's a few others. Nicolas Darvas is another phenomenal book. And I think going back to that evolution of how I've started to trade, I go to Darvas. Darvas was obviously traveling the world and really couldn't focus on the market. It's something that I try to detach myself from during the day. I don't always do it. Clearly during a pandemic, I mean, I'm not in the field as much as I normally would be in my main industry. So every once in a while, if I'm eating lunch, have a break, I'm looking down at my phone, I'm looking at the tweets and I want to get involved. I'm looking at the ticker prices. When I'm really out in the field and I'm working with the client, I don't have time to look at any of that stuff. So I try to say I'm more like Darvas, where I really only need to see end of day data and then more so end of week data. And that's important to what I'm doing for what I'm trading, because I'm not day trading and I'm really not swing trading. Now, that's not to say I don't take a swing trade every once in a while. I do. If I see an opportunity and I think I can exploit an opportunity because something's going to move maybe 20 or 30% based on what I see technically, I'll certainly go in and make a swing trade at that point. But I'm more that position trend trader, and I'm looking for that longer term. So someone might say, well, define longer term. What does that actually mean? For me, it's trying to get into a position that's going to last at least several months to possibly 1 to 2 years or so. Now, I do talk about having positions for 5 to 10 years and getting that large run. And that's where you can really execute on a 50x move. Easier said than done. And that's the struggle in my head in the growth account is how many stocks can I really hold for 5 years or 10 years? If I look at my current portfolio right now, there's only 2 stocks that I've had for 2 years in that account. And that's Square and Tencent. They're the only ones. Now, I have another other stocks that I've bought that are now over that 1 year mark, that long-term capital gain. Roku is one of them. CrowdStrike's another one. There's a few if I go down the list, but I still say about 60% of the portfolio is less than a year held at this point in time. And we've had some volatility, so I've made some changes to the portfolio over the last couple months or so. But I think the long term is at least for a couple of years. That's my goal, is to hold them for that period of time, capture that really good gain. And I think what we're witnessing right now in the market here on March 10th, and we had a pivot reversal and we're looking for this follow through day, is if we undercut the low, should I sell? I mean, we're already off 20, 30, 40% from the highs in a lot of these former leaders. And how much can you really withstand when you're coming off those highs? When you see your account that was at one level, now it's down here. And my account as of, what was it, about a week ago, I mean, the overall account was down 22%. And I made 6 sales in February. I started to see some top end action, and the trade desk was one of the ones. And I don't want to get out of order here within the interview, but the trade desk is a great example, because if you look at, I'll bring it up. Sure. I'll bring it up on MarketSmith. So let me pull it up real quick here. All right. So if you look at trade desk, and this is a weekly chart, so it's showing a number of different years here, and I'll switch to daily in a second. But what I was starting to see, and was this area right here, and I'll kind of point to it right there. I started to see some churning. Now, I bought this stock last March when the market went down, and I thought the stock just got unfairly undercut, hit really hard. And I picked up some shares the week of the 16th or so. It was about $172 or $174 a share. It did go lower than that. I think it went all the way down to 130 or so. So when I first bought it, I was like, maybe I'm catching a falling knife here. But I thought it was unfairly hit, as most of the market was. And there was a major signal, an indicator that I use. It's the percentage of stocks that are trading above their 50-day and or 200-day averages. And historically, when those indicators go below 5 or 10% of all stocks in the market that are now below those major moving averages, especially the 200, you only get that signal maybe once or twice a decade. And that's one of those signals where it's like, back the truck up and go buy a lot of your stocks that you think from a conviction standpoint are going to do really well in the future. The trade desk was one that I had missed the previous year, and I didn't get that run that kind of went from like June 18. This run I didn't get. But as soon as that thing pulled back, I said, here's my chance. I need to get in right now, because I think this thing's going to keep running. And ultimately, if you took that red line, it just kept going. And that was the run I was looking for. So I got into it. However, it ran really strong for 8 or 9 months, and then I started to see it churn, and I was seeing some volume that was heavier down here. It was above average, and it was red, and the stock wasn't moving higher, wasn't moving lower, and I figured there's a struggle between the buyers and sellers at that point, and I just thought it was starting to get top heavy. I sold the position. I sold the position at 844. It went down into the 500s last week. Now, if you look at the chart today, it's up at 722. It's really recovered nicely. Maybe I prematurely sold the stock, and this is the struggle. This is the battle we have in our head. Do you want to cut losses? Do you want to get out of stock when it tops? Or do you want to kind of just ride it for the long term because you think this stock's going to do really well for the next 5 years? And I think that's the struggle we all have right now. It's one that at 42 years old, I'm still kind of battling in this growth account. What do I want to do? I did sell that one, and I sold a bunch of other stocks that were in the account as well. And they're all down from where I sold them, but there are tax implications. And if the market does bounce back, we get a follow through. I have no doubt that this stock would be right back up to $850 a share. If the market does roll over, I do think it's going to base and form a much longer base over many months, and I'll have an opportunity to get back into the stock at that point, as it kind of either undercuts the 200-day moving average, or if it just forms some type of a cup with handle type base, maybe a saucer base, maybe just a flat sideways, whatever pattern that it starts to form. I think it will give me an idea. If it builds some support somewhere, I can get back into the stock itself. So that's just one example of one of those things from last year.
No, that's a great example. And I actually tried to, I had traded in and out of it a little bit in 2020. I actually tried it again when it broke out right above pretty much that line that you drew there. But it just reversed and gave me a sell signal the next day. So I actually cut it. And now it's back at the 200-day. We'll see how it goes. But that one bar down the 200-day, that's not a good looking bar. And so far this week, it's just an inside week. So its direction is kind of, who knows? We'll see.
Exactly. Yeah, it's debatable where it's going to go at this point. And I mean, we're only halfway through the week, but if you look at volume, it's still lower now. I think it's going to come up a little bit higher. But these stocks, these growth stocks, they need time to build a base. And if you go back in history and you look at the former leaders from yesteryear, the Apples, the Amazons, the Netflix, the Googles, those stocks have had tremendous runs, but they've all formed bases. They've all come back to 200-day moving average. Something I say very often on my Twitter stream is they're all going to come back to their 200-day. And last year I got challenged so many different times on so many high flyers that, oh, there's no chance this is coming back to 200-day. You're a dream and it's not going to happen. Well, Zoom, TDoc, Trade Desk, I mean, Shopify, I mean, I haven't seen where that's in. That's one I actually missed. But if I pull that up right now, there you go. It's at the 200-day. I mean, all these stocks come back to the 200. And if you look, I mean, back in March, the 200-day, it's 200-day now. It's 200-day here. Now they have these long runs in between. Right. The idea is if you think this stock's going to continue, and right now it's got 1,700 funds that own it, institutional support. But if you look at the sales, I mean, the sales are still incredible at this point. And more importantly, now this is a stock that back in 16 to 17, it went from negative to positive with earnings. It is crushing it on the earnings side. So Shopify is a stock that over time, it's got a market cap of 126 billion. I mean, it could probably run another 5x from here if it becomes a $500 billion company or even greater. Some people think it's going to be another $1 trillion company that hits the market. So I see those pullbacks to the 200-day, especially if it forms a base, as a fantastic risk reward play to say, I'm going to grab shares here. Maybe it goes a little bit lower in the interim, but in the long term, it's probably going to go higher. And now's the time to get into that stock.
It makes sense. And it's very, very interesting what you just said. They always come back to the 200-day. I think that's an important thing for people to remember. And in the middle of 2020, we saw a lot of stocks up 100%, 200% above their 200-day moving average. And that in in more normal times, not 2020, that's kind of the edge of what happened, but they just kept going. And now we've seen finally a little bit of a correction, especially in a Zoom that would just flew up there.
100%. And if you look at your Shopify right here and you go to September to December 2019, and you're looking right in this range right here. Yeah. Same thing. You have a stock that's probably 70% above the 200-day moving average. It never violated it come late 2019, but it went back and it touched it basically. And it was one of those things where it just had to kind of pull back. It's almost the standard deviation play. It's got to come back to the norm at some point. And as you can see, a stock can go from December 18 until almost December 19 to kind of touch that line again. So it can go a full year. As we know, these things can last a lot longer than any of us can imagine, both on the upside and the downside. And great stocks will run, but ultimately they will come back to those lines at some point. And they are imaginary lines. They're not true lines, but it's something that historically folks on Wall Street use. Big institutions use it, big traders use it, the programmatic trade, and they all use these lines as well. So there's things that are written into code and triggered that psychologically folks know when it gets to these levels, it's either a great buy or that's the point where it's going to flip and it's going to break down at that time. So you want to really look to see. I don't think anyone really has to be super quick, and I know the market moves very quickly these days, but I know some younger folks in the market say, oh, the markets didn't move like this in the past. They did. I mean, the volume's a little bit different. I think more retail investors are involved, but the markets moved quickly throughout my whole career. I mean, the late 90s was incredible how the market moved, and then it got a lot slower, and then 08, 09 came, and the market was moving like crazy again. It's just historical patterns, and it's all the human nature that it comes back to. So whether it's Bill O'Neill talking about or some of the other authors I talked about, we're programmed in our DNA to kind of look at these things in a similar way, whether it's 2021 or 1921. We're really kind of trading these and approaching the market in the same way. So we're going to react in the same way. So the cycles will repeat. It won't be exact. And a chart's not a fortune teller. It's not going to tell you where the stock's going, but it's going to give you a general idea of what the sentiment is of the overall crowd at this particular time. And are we catching support? Are we just looking to base right now? And do we have potential to go forward? And it's not a guarantee when you make that bet, but hopefully it puts some of the odds in your favor based on using some of the technicals and knowing the fundamentals are so strong. So you're looking at the earnings, you're looking at the sales, the fundamental story is there. And I think with my style of trading and investing, it's a mix between fundamentals and technicals. And it's I really, the foundation of what I do is from CANSLIM. I don't follow to a T, and there's a lot of stuff that I do a little bit differently when it comes to sell rules and where I buy and how maybe I pyramid or scale into a stock. Those things might be a little bit different, but from a pure fundamental and technical standpoint, I'm doing most of my screens with fundamentals first, and then I'm looking at the technicals next. And some people say it's voodoo. Some people say it's chart art. You don't know what you're talking about. For me personally, it helps me a tremendous amount. And if you read the Market Wizard books, and that's a whole nother set of books I really recommend, especially the first two. If you read those Market Wizard books and you go back to some of those really great traders, and some are still around today, a lot of them said that they made some okay money or weren't making any money. And the minute they kind of tuned in some technicals, that's when their careers went gangbusters. And so I truly do believe that technicals help. I like them. I keep it very basic. I like candlestick charts. I like the moving averages, the 50-day and the 200-day. I will use some candlestick indicators, maybe a hammer indicator or maybe a reversal indicator here and there, but I don't go too crazy into dojis and this one and that one and all these other things that you can kind of look at. And then for pure support and resistance levels, I'll use point and figure charts. It's a very old school form of charting. Not a lot of people use it these days. Stock Charts has a lot of it on their site. I subscribe to their site and use their charts and store a lot of the things that I'm looking at over there, in addition to MarketSmith here. And I just like to look at the support and the resistance levels on a point and figure chart, and then really kind of map it on a candlestick chart to see, does it align, does it make sense, and where would I want to get in, or where would I start to get nervous and want to sell if I hold a position.
Absolutely. And just going back to the shop chart for just a second, I'm noticing that it's also kind of right near that psychological level of 1000, which is also kind of the meat of the previous longer term base. So it's interesting how the 200-day is kind of in confluence with that key support level. So we'll see what happens with shop. And actually you kind of stepped ahead a little bit and answered my next question, which was what kind of tools you use for both screening and also down to the minute that you're buying and selling. What kind of software and tools do you use?
So having MarketSmith up, I can kind of just pull up a couple of screens here and just in general, we'll take a look at them. So here on the left, if you can see that, I have the first one highlighted, says daily new high screen. And all these screens here are really my custom screens. And if I scroll down just for one moment, I can get into community screens down here. And our earnings due this week, fundamentals for growth, pullback screen, stocks resistant correction. These are some community screens I've just kind of gravitated towards over the years that I thought were really good. But ultimately, I've built my own screens to say, what do I want to see each night? And daily new high screen, it's first on the list because this is the first thing I always look at. So if I just double click this from today, and then I'm going to pull this up in a second, it's going to tell me 87 stocks made a new high today. I sorted by price percentage change. And then I'm also looking at the 3-month relative strength rate. And then right next to it, I have the relative strength rate. And relative strength is more for 12 months, the trailing 12 months. And 3 months is the trailing 3 months, which gives you a little bit more information as what's going on more recently. I'm going to go down this list and I'm going to look and say, okay, number one, are any of them flagged? Right here, I've got none of them flagged. So it's nothing that I'm really following. So it's probably not the stocks I want to get into. And every stock I'm looking at is not flagged. Obviously, there's new stocks that come in every day and I want to see them. Looking at this list just today, it's really interesting. I actually worked at Hovnanian. I had a short stint with them back in the mid 2000s. And it was Lennar and Hovnanian and Ryland and all those big home building stocks. What's interesting is they're doing really well right now. And obviously residential building is doing really well. When these guys were doing well in 04, 05, 06, it was just before we actually had the market bust. You had these stocks, you had some other financial stocks were doing tremendous. And I'm not trying to align the two together. I'm not saying we're going into another 2008, but what I'm noticing is you're getting a lot of these stocks that kind of led before the market declined back then, and they're starting to lead now as well. But this is the first screen I get into. I don't want to get too far off base, but it kind of just shows you what stocks are up today. So I just want to see who's leading the market, who's making new highs. And that's the first screen. And that's something Bill O'Neill would always say is look at the new highs. One, what stocks are making new highs? And then how many stocks from a certain industry group are making new highs? All right, so what we want to do here is, I said one screen I have is the new highs for the day. I also want to look at the industries, and I have a screen that I save, and I say, okay, how many new highs are coming out of each industry group itself? So right now I'm going to say number of new highs, and this is data from today. The first one is ETF, ETN, so we're going to get rid of that for a second. We don't want to see that guy. banks, finance, and kind of go down the list, and you look at it. New highs say 43, 41, 30, 27, 25, 22, 21. All your new highs are coming out of banks and finance companies. Now that gives you really important information. It tells you these are the leading industries right now. If you want to buy stocks that are going up in industries, it's been oil and gas, and it's been the banks and the finance companies. Me in particular, I'm not a big fan of these industries. They're not stocks I want to own. I think they're a rotational play. And if you're a trader, hey, go into them and you could probably make some good money. And I think these will lead. And it's not like overnight they're just going to stop leading. Right now, they're in a trend and they're going to start going up. I don't think these trends will last very long. But it's just really, if you kind of go through these groups and see what type of stocks are in, banks from the Southeast, banks from the Northeast, banks from the Midwest. For me in particular, and I don't want to kind of crumble down anyone else's castle, but it's just not the type of stocks I want to go into. So I look at this and say, hey, let's pump the brakes here, because the growth stocks I'm into, so your tech companies, some of your online retail companies, your cloud companies, now you've got a lot of SPACs coming out, stuff like that. They're not leading the market right now. They're not making new highs. So maybe I should pump the brakes. Maybe I should trim some of my positions, or I should get cautious. Do I want to hedge? I mean, that's something I can kind of think about and get into, but this gives me a lot of information to say who's leading the market, and it does it align with what I want to do and how I want to trade the market. And right now, this particular screen right here is telling me, no, this is not what I want to see leading the market at this point in time. It's not a bad thing. It's just for me in particular, for what I'm doing, I just have to know in my psyche, these aren't the stocks that are going to lead the market for me. So let's go back to the screen for a moment. Let's move this over. So if you go to daily new high screens, and I kind of just open this up for a second, it kind of just shows you on the right hand side of the page here what's built into my screen. So I'm looking at a relative strength rating of at least 70 or greater. So what that says is it's a stock in the market that has a relative strength rating recently that's greater than 70% of all other stocks in the market. I'm looking at 50-day average volume of at least 100,000 shares. So I don't want small micro stocks kind of making my screens. I want stocks that have some volume in them. I'm also looking at stocks that are a percentage change in volume versus their 50-day average of at least 15%. So if it's a stock making a new high, I want to see the volume at least 15% higher than their average. So it's all right. So there's institutions that are piling into these stocks at this point. So when you look at the list, you're saying, okay, these stocks are starting to have some accumulation. And it's something that CANSLIM will say is, what's an accumulation day versus distribution? Accumulation simply states it's a day when the stock is up 1% or more, usually it could be 2%, on volume greater than the average. So in this case, I'm looking for something above 15%. But if you see something at 50 or 100% above the average, well, you know, institutions are really starting to pile into that. That's not retail moving that stock. That's definitely funds moving that stock. On the flip side, when you see a stock break down and it's down 2, 3, 4, 5% of the day and volume is up 50% against the average, well, that's a stock that people are actually dropping at that point, and distribution is clearly happening. And that's the same with the overall markets. If you look at the NASDAQ or you look at the Dow, you want to see accumulation days versus distribution days. And when you start to see distribution days add up, that's where you start to get nervous. And when you have a period of 2, 3, 4 weeks where you start to get 4 or 5 distribution days, it's the market giving you a signal to say, hey, hold up, we're putting the brakes on and things might be heading south right now. And those are things I look for in the individual stocks as well.
Right.
I'll briefly kind of go down some of these other ones real quickly. I won't go into full detail, but
sure.
I also look at daily highs within stocks within 15% of a new high. And if I come in here and I kind of look at the edit, what am I looking for? Very similar, above 70 rating, the same volume, same percentage volume change. It's 15% off the high. I add in this comp rating here a little bit, and this is a proprietary rating that takes all the 5 major proprietary ratings that CANSLIM uses in the MarketSmith system, and it rates them from 0 to 99. Anything close to 99 is great. Anything down near 1 is probably not so great. And it's looking at earnings, it's looking at relative strength, and it's looking at a couple other major criterias. And it's kind of just giving them an overall proprietary rating. So I like to see things over 60. I loosen this up a little bit. I believe IBD says 75 and greater, or 70 and greater is what they normally go with. I loosen it up a little bit, and I'll let myself kind of make that determination. If it's below 75, should I consider it or just throw it out like they normally would?
Right.
New IPOs. I love looking for new IPOs. This is a key screen. And I have 2 back to back. One has some criteria that it needs to meet in order to get there. So the comp rating is at 50. RS rating is actually pretty low at 30 because I'm trying to get as many of these stocks into the screen as possible. Now, if you look at the overall universe, there's 8,000 stocks in MarketSmith universe. As soon as I hit the RS rating, it drops down to 58. And as I go through these ratings, it's screening out all the stocks, and it gives me 29 names right here. So if I say, let's view this screen result, new IPOs today, I'll pull this up. And right now it's by 3-month relative strength is what I have it actually sorted by. Let's go to price percentage change just to see who did well today. And I haven't looked at any screens today, and it'll give you all the stocks that have done well. And you see some flag stocks down here as well. So Pinterest and Cloudflare and Twist Biosense and Square. So some stocks that were up nicely that kind of still meet this screen criteria of being a stock that's been a recent IPO. Now, my IPO screen right now goes back to about 2014. In the next screen where I actually reduce some of my criteria, I break that down to 2017 and younger. So stocks that have come out in 17, 18, 19, and 20. So I look for some stocks there as well. So I actually reduce the ratings here. I get rid of some of the criteria, and I'm looking just for an RS rating really over 50 at this point. And what that's scanned for is just brand new, young, innovative companies that maybe I haven't heard of. I think, Richard, you and I know Twitter, you hear about a lot out there. I mean, pre-Twitter, you wouldn't hear about half of these companies. With Twitter, somebody's out there screening all this stuff as well. So somebody's always bringing up one of these stocks. But I like to kind of rely on what my screens are telling me. I'll see stuff on Twitter, but if it's not making my screens, I'm not touching it. Just because this is a proven method for me that I wanted to make the screens based on the criteria I'm looking at. And then some other key ones that point out, I mean, I'm looking for sales rising over the last 4 quarters, strong closers daily, strong closers weekly. So these are stocks that either close the day in the top 25% of their range or top for the day or for the week, both of those screens. And there's some other criteria built into that. Stocks between the 50-day and 200-day moving average. This is what I call a pullback screen. So once stocks violate the 50-day and now they're moving back down towards the 200, I want to capture those stocks that are in between those two moving averages.
Right.
And if they're in there and they hold support at the 200, if they go down and touch it or slowly kind of cross below the 200-day but hold support there, those are stocks that I'm definitely interested in getting involved with at that point. So that's an important screen for me as well. This one right here is a good one. A lot of people like this one. This is called fund sponsorship increase. And so what I do here is I set this up where, and it's this first line is the key one. The percentage of funds that have bought into this stock at least 10% or more from the previous quarter. So I'll run the screen just to show you an example so people can follow this a little bit on video. You'll get some outliers like this 40,000%. Let's just use DraftKings. This is a good one. It says percentage increase, 72%. So if we click on the chart for DraftKings and we come in here, what this is telling us, as I kind of pull this down for a moment, and I'll come over to fund sponsorship actually on the side here. Back in September of 19, they had 17 funds owning it. By December, went to 40, then 65, 248, 294. Now they're at 507. So that's 72% or so. It went from 294 funds in the September quarter to the December quarter at 507. And as you see the chart, look what it did. It made this run right here. The reason it made that run is because all these funds were piling into the stock. What also backed that up is you had sales that were starting to increase. You had states that were starting to legalize gambling. So it made a lot of sense to say, okay, DraftKings is probably a stock that's going to go up in the future. Now, from an earnings standpoint, that's still a problem. Earnings are slowly getting better, but they're still negative. If you go out to estimates for 21 and 22, still negative 159, negative 120, but it's trending in the right direction. So this stock probably has a lot more play going forward in the future. I don't own it at this point. I think it's been a good one. But this is a screen that's looking for stocks that the funds are piling into. I want to buy what the funds are buying. And usually the funds are buying what other funds are buying because A, revenue is going up, and B, we have earnings that are eventually either going to improve or go from negative to positive. Or if they're already positive, they're going to go to a lot more positive at that point. And that's ultimately what fuels the stock price at the end of the day. If you have revenue and earnings going up, I mean, the stock price is going to follow it. You'll have temporary drawdowns, you'll have temporary pauses and bases, but ultimately, when you look back in a few years at a stock, when you're looking at numbers like this, most likely this stock will continue to trend upwards. And I think the wind is behind DraftKings because they're going to have a lot more states. They're going to legalize gambling throughout this country and elsewhere around the world, and they're just going to grow their user base at this point. Now, I think their market cap's at 54 billion, so it is quite large. I don't know how much growth is going to have from here going forward if you look at what their sales are at versus what the market cap's at. So it's probably trading at a large multiple at this point for both trailing sales and forward sales. But definitely one that's interesting. And I know there's some really, really good folks out there. A lot of people follow, obviously, ARK and those folks. And Kathy Wood's really been piling into DraftKings lately. Again, I don't own it at this point. But something else that's great, and this is to plug MarketSmith a little bit, and I don't make any money off plugging MarketSmith, but as I come over to the right side of the screen, I can look at these funds, number of funds, but down here, there's a button that says Show Fund Ownership.
Right.
And if I click Show Fund Ownership, another screen opens up. And now I can go look at all the companies that actually own DraftKings and who owns it as a large portion of their portfolio. And if there's certain funds in here that I've noticed over time do really well with picking these young growth stocks, I'll make note of that and say, okay, XYZ fund has now bought a large position in this, or is increasing their position in this stock. Let me keep an eye on it because they've done well with boom, boom, and boom in the past. And if you start, and you don't want to just pinpoint one fund, but if you start to see 4, 5, 6, 7 really solid funds that are piling into the stock, it's something you want to take note of. I won't call myself an expert on the funds, but there's definitely a few funds here and there that I followed over the years to say, that's a fund I want to kind of watch what they're buying. You can dive deeper into this and drill down and say, okay, if I want to go into T row price growth stocks, I can go see all the stocks that they owned right now and just dive into that and say, what else do they own outside of DraftKings?
Right.
One thing I notice here is percentage of shares held is still very low considering some of their other positions. So this gives me another hint to say, if people really have conviction in this stock, they certainly can increase their position size going forward in these massive funds, which means as an individual investor like us, a retail investor, we can either A, take a position or increase our positions and kind of ride along that trend with them as well. And I'm not saying it for anyone here on this podcast to go out and buy DraftKings, but this is just the process I go through when I'm starting to analyze a stock, going through my screening process. So it starts with the screens. I look at the technicals. I look at the fund ownership. I mean, those are really the key components I look at to say, okay, now I want to come up here on the top and I want to click this flag up here and make this part of my watch list. And then I'll start to watch it day to day at that point. And at some point, if it gives me a nice risk reward setup, I'll enter the stock.
Very cool. And you kind of went through it a little bit, but how much do you care about the story behind a company that you potentially invest in?
I do. And growth stocks can be challenging. If you're dealing with a stock that's a brand, Uber, Airbnb, Netflix, right, whoever, brands that we know and products that we use every day, it's a lot easier to justify the conviction because Roku's another one. I use that. I have, and I'm just saying like Netflix. We have the Netflix account. We've had it forever. We use it. A lot of people have Rokus. Some people say, "Oh, I've got 3 Rokus in my house." Oh, my brother and sister just bought some Rokus, and you can kind of just justify the story because everyone starts talking about everybody's using the product, and then you're seeing funds start to load in, and then you're starting to see the stock price go up and accelerate. So that makes sense. If you get into some tech stocks, and I'll just use one example, or I'll use 2, maybe like a Datadog, or you get into a Fastly or a Cloudflare. On the surface, I generally understand what they're doing and how they're trying to improve the experience for somebody. If you're using an app, for example, and you say, okay, I'm using this app and it's seamless, it moves quick, it works really well, it's not bogged down. There's a technology down there that Cloudflare or Fastly is kind of implementing that's with the base company that's using that app to get the experience to us to work really well.
Right.
High level, I understand that. From a technical level, I can read about it, but I'm not going to pretend like I actually understand all the details from a technical level. So it's a little bit hard to get intimate with stocks like that. If I know it makes a lot of sense at 50,000 feet, I'll say maybe I should buy this stock because, all right, every app maker and every user experience type platform or software is going to want to run on software that allows the user experience to be really great. Right. And from what I'm reading, based on their clients, these are the companies like, say, TikTok, for example, was a client of Fastly, and they were no longer. And TikTok has a really good user experience when you go into the app itself. I don't use it a ton, but my kids use it a ton. And it's a great app and it's really expanded at this point in time. So I'll look at that story and say, okay, why do I want to own this? Does it make sense? Do I think it's going to grow? Do I think the technology is going to stick around for a few years and improve upon some other things that's just going to make their company a lot better from both a growth standpoint, revenue, and an earn standpoint?
Very cool. Very cool. And we've pretty much covered your kind of screening process as well as the fundamentals and a little bit of the technicals of what you like to see in a stock you're interested in. And now I guess I want to move on and talk a little bit about actually going ahead and buying a stock. So what makes you, once you like the company, once you've been watching it for a little bit, what makes you go out and purchase shares, whether it's entry setups or some other method?
Definitely. So I showed the screens that I have for the IPO stocks.
Right.
One thing I've seen just myself, my own experience, a lot of stocks come out in IPO, and forget 2020, but just in general for the last 20 years, I've been doing this. A lot of stocks will come out and like to run hard right out of the IPO. And then ultimately within the first 6 to 12 months, they like to base after a nice run for 6 to 12 months. And they have that first natural base for the stock itself. typically that's when I like to get involved in that stock. And whether that's a pullback to the 50-day or 200-day, or it's truly just one of those prototypical bases. And a cup with handle is one of my favorites. I love a company that really kind of rounds out a nice cup shape base. And I like to get into the stock at that point and buy shares. Where I start to deviate from CANSLIM is I don't always wait for that handle. A lot of times, if I like the company, I like the conviction of the company going forward, while it's building the right side of that base, and I try not to grab it on the left side, although it happens. I mean, Zoom recently was kind of coming down to the 200-day moving average, and I know it's had a heck of a run, and whether I bought it at the right spot or not, I mean, the chart's looking a little sloppy here, but as this chart was kind of coming down towards the 200-day moving average, I'm like, all right, it looks like it's basing now. I thought maybe I was buying it towards the bottom. Now, I might have still kind of bought it near the bottom, but the bottom part of this base might want to extend for many more months and then eventually build the right side, which might be many more months beyond that. So Zoom could be in a base here for another 6 months or so before it really wants to go up towards the left side of that cup and eventually go on to new highs. So shorter term investors are going to get really frustrated and they're going to leave Zoom at this point. Now, it's kind of at the precipice of, is it going to roll over? I mean, it certainly can roll over at this point, and that's something I'm a little concerned about. I've sized the position well enough where if it started to roll over, I'm not too concerned about it at this point. I don't have an 8% sell stop on the stock. I'm down more than 8% in my position from where I purchased it. But I'm keeping an eye on it because I do think Zoom as a company 5 years from now, you're going to look back and say, okay, wow, I got that stock fairly cheap. Now, it might go a lot cheaper. It might get a lot cheaper at this point. So we're looking at $336 a share. Could it drop below 300? It certainly can. And I mentioned the Stan Weinstein book on Twitter yesterday. I mean, you have stage one bases where stock's basing out before it breaks out. And ultimately, I'll just draw this real quick. If we look at, this is kind of stage one down here. This was the stage two. And now we're kind of in that sideways stage three. It has to make a decision. It's either going down or it's going back up after it finishes the stage three. I don't know where it's going. I don't think anybody knows where it's going. But I look at the sales, I look at the earnings, and I just look at the product itself, and I look at the potential of other companies it could acquire and kind of add into what it's doing. I work in the real estate industry. I'm commercial architecture and commercial construction is what I do. I essentially act as an owner's rep, as an extension to clients. And one of the things we're hearing from a lot of our clients these days is there's going to be 3 tranches of people coming back to the office. You're going to have those people that are truly just assigned to the office, folks that want to come in 4, if not 5 days a week, just because that's what they love to do. That's where they're most productive. And that's going to be probably 15 to 20% of your workforce. Then you're going to have a percentage of your workforce is probably 50 or 60% that are going to be hybrid. And they're going to want to come back to the office maybe 2 or 3 days a week. Right. On occasion, maybe it'll be 4, probably rarely 5. And they're going to want to be home at least 1 to 2 days a week. And they want to have that flexibility. So they're going to do heads down work at their computer at home. And they don't want to socialize with anyone. They don't want to make the commute into a big city, or even if they're suburban, they don't want to make that commute, get dressed, take the shower, get up. They just want to go right to their computer and just start work. And they feel like they're more productive a couple of days a week outside the office. And then it gives them a little bit of that life work balance. So if they need to go to the dry cleaners, they need to go to the supermarket, whatever it may be, it just kind of allows them to have that rather than being that 5 day a week, 9 to 5 person. And that's probably 50 to 60% of your workforce. And then you have the last part of your workforce that's going to be fully remote. And there's a lot of companies out there that were already starting to go there. COVID accelerated it. And you're going to have some more traditional firms that really didn't like remote, but they're going to have employees that say, okay, you know what? We could probably, if we're based in New York City, I could probably get better talent at a much better rate elsewhere in the country and elsewhere in the world. Let's hire a bunch of remote workers, or let's allow a lot of our workers go full remote. And maybe that's your last 20% of your folks as well. So maybe it's 20, 60, 20. And I'm rounding those numbers off of the 3 tranches. So how do I wrap that all together? Zoom is going to stay in play. It's not just a COVID play. Now, certainly the sales are not going to maintain 100 to 300% Q over Q. That's probably impossible to maintain that going forward. So sales are going to pull back. And I think that's why the stock's based right now, because now it has to digest that huge run that it had in 2020, digest it, kind of start to determine, well, where do I want to go in the future as a stock? And where the sales and where the earnings going to kind of land post-COVID? And then how does this stock kind of trend in the future? I ultimately believe it goes higher over time, but it might have a rocky period here in the next 6 to 12 months. I own it. I haven't sold it yet. It's definitely one of those borderline ones, but it's one of those ones where I'm playing that game in my head. Do I want to hold this long term, or do I want to just cut it and revisit it in the future once it kind of completes this base? And the market gives me more information as far as where Zoom wants to go. And 1,400 funds own it right now. So if you look at that, right, there's 1,400 funds right here. It's got a lot of institutional support. The question becomes, though, it's a double-edged sword. Do several hundred of those funds want to dump the stock, or do they want to maintain their position? And does that number increase? So that's
Right.
also telling in the next earnings report to see where that 1440 goes. But even more important is you can do a deeper dive and say, okay, 1,400 funds own it. And if it goes up next quarter, well, how many shares do they actually own? So how many shares do they increase ownership in? So if the funds go up by 20%, did the shares go up? Because you ultimately could actually have more funds owning the stock, but have fewer shares that are truly owned at that point. So that's something else that I look at as well.
Makes sense. Makes sense. And it could be forming a kind of very long-term double bottom base here because it did just undercut that low. And I was actually involved near the 200-day. There's a nice big blue bar just a few weeks ago that really started this most recent attempt at an uptrend, but I did unfortunately cut it the last few weeks just because it broke my expectations and broke the shorter term trend. So we'll see what happens. Obviously, I use the product every single day in class at university. I'm doing my classes by Zoom, and right now we're using the Zoom technology. So I'm a big fan of the company and the product, but we'll see how the company does.
Yeah. And school's a big point. My kids, I have an 8-year-old and a 12-year-old, and they're hybrid at this point.
Right.
But every student in our district, every student in the state of New Jersey is using Zoom right now. If in September we go back to 100% in-class normal school schedule, well, Zoom goes away for all the schools. Now,
right.
I know corporate is really what drives it, not schools, but the schools and the education has been a huge boon for Zoom in the last 12 months. So that's what's going to come off the balance sheet is all the revenue they've been making from the schools. Now, I do think I live in the Northeast, and we had a tremendous snow season this year. We had 3 to 4 feet of snow here where I live, which normally we don't even get that much for the whole winter. We had that 1 month. So something that was different this year is there were no snow days. It was just, hey, it's a Zoom day today. You're just not physically going to come to school. So if
that's
cohort
a sad
A,
thing.
It is a sad thing. And I think as a parent, I think every once in a while you say, give them a couple snow days every year and let them go out and sled or sleigh ride, whatever you want to call it. But we'd get the notice the night before at 7 o'clock and it would say, hey, we're supposed to get a foot of snow tomorrow. We're going full virtual. None of the teachers, none of the students are coming in. So if cohort A or B or C were coming in this particular day, everybody's virtual tomorrow and everybody was on their Zoom. So we'll see how that plays out. I don't know if school's going to be like the corporate world and say, okay, we're going to have that flexibility. And I don't think we'll have students that are just going to be virtual, but maybe there's certain instances where they're going to go virtual. So maybe they'll keep certain accounts live. I don't know how that works on a school enterprise level with Zoom, but I think Zoom as a whole is not just a COVID play. I think it's here to stay, but it's definitely going to slow down here in the immediate future. So I think when you look at that chart, it's a little ugly right now, and you have some big distribution there. Can it maintain itself under the 200-day? Now, I use the 200-day to kind of gauge if a stock is catching support. They all don't just stop at the 200-day. There are so many examples throughout history where they undercut the 200-day and build the base below the 200-day, but not too far under the 200-day. And then they start to kind of build back up. They recapture it, and that's usually a bullish signal. And then they start to build the rest of that base, and off they go from there. So it's not an automatic sell for me if it cuts the 200-day, if I have a lot of conviction in the stock itself. So sometimes that can get me in trouble because I don't have that automatic sell rule. Other times it allows me to stay in a stock. Roku was one last summer. I bought it at 133. The stock went down to 100. I mean, if you followed rules to a T from a canceling perspective, I should have sold that stock. I stayed in it. And as we all know, it ran over 400 at its peak and now it's back in the 300. So it's one of those ones. And actually I could probably just pull it up real quick. Just to show that example. If I pull up Roku. So here you go. You have March of last year. Let me go to the daily. Actually, it might work a little bit better. Yeah, I guess it doesn't. We'll go back to the weekly. Essentially, I was buying the stock probably right up here, but then it came back to the moving average here. It doesn't look large on this type of chart, but ultimately the stock came back 25%, and I was showing a 25% loss in my position. Now I stayed in the position because I believed in it, and I tweeted about it. I have conviction in it. A lot of people are saying, "What are you doing? Why are you staying in the stock?" I would say June of last summer is different than now. Valuations are different, and where we were in the world then. In hindsight's a little easy to say that, but at the time I was nervous. But then we saw what the stock did. I mean, it made that run, and now it's starting to make a correction. And it might want to make some type of base over here before it kind of comes up, and then eventually goes on its next run. And here's another stock that earnings are now turning positive. Revenue continues to expand. I think it's a stock that's just had a tremendous run over the last several years where it needs a base at this point, and ultimately it will run again. So if you're a longer term holder, hold it and hold yourself through the base. I don't think Roku's going away. I don't think it's going to crash and burn, and kind of just going to mentally work your way through that drawdown and pullback. And ultimately I think you'll be fine a year or two from now. If you're more of a shorter term investor, if you think it's starting to violate some of your sell rules, then sell it, get out, clear your head, watch to see what it does from a base standpoint, and then you can always get back in. The fact that commissions don't cost us anything anymore. When my father traded, commissions were anywhere from $150 to over $200 per trade on each end of the trade. I mean, you want to talk about really erasing a lot of capital based on making trades. And that's why he was a longer term trader, is because he didn't want to pay $200 on each end of a trade. Today, we don't pay that, other than tax implications. If you're in a taxable account, that's the only thing that really would maybe make you think about going in and out of something. And I'm not a day trader, but some people do trade and swing like this. Right now, Roku kind of gave you signals, get out if you're a swing trader short term and see what it does. And if it catches support somewhere, then maybe you can get back in.
Makes sense. So it doesn't seem like you use the technicals too much to enter in and out of the position. You are using them a little bit for the overall trend. I assume you want to see the 200-day or the 40-week in an uptrend while you're buying it. But it seems when you're actually placing the buy, it doesn't factor too much into the equation because you are willing to give it that room.
Yeah, I will give it the room. The one area, and this is why I've missed stocks like Shopify and Melly and a few like that, is when they get a little bit extended beyond the moving averages. If I've missed it, I won't chase it. Now, 2020, I guess it didn't matter. You could have chased anything and it still would have went up 100-200%. But normally what I've seen over my career of investing, if you start to chase a stock, that's where you get hurt. If you buy it at the wrong spot. And people say maybe buying's a lot easier, but if you buy at the wrong spot, it just makes your gain and your possible sell for a loss a lot more likely at that point. So I won't chase. C Limited was one where I was staring at it at $37 last year, and I was already buying some other stocks like the Trade Desk and AYX and Work and MDB. But and C Limited was one I really wanted, and for some reason I thought it was going to pull back a little bit more, and that's where opinions get cloud your judgment. Sometimes I should have just got in. I should at least bought a third of a position at that point, even if it wasn't a half or a full position. I should have just went in, bought a third of the position, and said, okay, if it's at 37 now, I know the market's getting crushed. I wasn't quite sure if we were really fully coming out of the COVID crash at that point. All right, so if it drops back down to 30 or 25, no big deal. I like it long term, and I could always add more. I didn't do it, and the next thing I know, I look up and it's over $100 a share. I didn't buy it until 145. So it's funny, and that's something I've learned over the years. That's something I would never be able to do 15 years ago. If I looked at a stock at 37 and now it's trading over 100, I would never buy it in the past. I just couldn't. It was just mentally, it would make me so angry and upset. I think as I've gotten older and age is maybe more mature, saying that's just silly, because if it's a great company, it will continue to run over time. Forget about what the past is. The past is the past. Erase that. The market doesn't care about what you thought. If at 145 you still think it's a good deal, buy it now. And as you know, it's up near 200 now. It was well over 200 at one point. It will work out over time. And I think C has a long runway going forward. Another one that may want to correct a little bit here. But yeah, I think that's one of my greatest lessons learned over time is forget about what maybe you did in the past, whether you entered a stock and you made money off of it and you sold it for some reason, or you enter stock and you lost money. Just erase that, because the story and the narrative doesn't change because of a trade you made that might have been a wrong trade. So I've kind of just erased that. And you say, well, how did you teach yourself that? I think it was just age, really. I think I just matured and said, okay, it doesn't stress me out like it used to. It's no big deal. I'm going to get another opportunity. So just take the next opportunity.
Oh, I think that's a great point to make. Never be afraid to buy back into a stock that's still got a great story, great fundamentals, just because it didn't work out the first time. I think that's a great point. I have a question about the stop losses, because usually when a stock that I buy drops even 5%, that's kind of how I take it. The market telling me I was entering at the wrong time. And obviously I'm a bit of a, I'm definitely a much shorter time frame than you are, more swing position trade, but still the classic CANSLIM is max 8% and hopefully a lot less than that. And you can try it a couple times. So what's kind of your mentality about letting a stock, obviously you have a ton of conviction, but if a stock has dropped 25% for my buy point, I've definitely done something wrong based on my own risk reward relationship. So I guess talk to me about that process and also how you manage risk, maybe with position sizing, to make it work for you in your account.
Sure. So start with the last part of that question. I definitely manage the risk with the position size. And so I post my growth account up once a month. So usually the first day of the month, and just say, hey, here are the positions I own. This is the percent of what I own in each stock. I don't normally let a stock go above 10% of the account in that particular account itself. And most of the times I'll scale into a stock. So I'll say, okay, I'll buy with a 3 or 4% initial buy. And over time, I'll start to scale into it.
Right.
Your point, if the stock starts to work and it's going higher, well, I bought it at the right spot at that point, because now it's telling me, the market's telling me you're right. You can start to scale in. So the cost basis will go up. So between appreciation and buying additional shares, Roku's a good example where I bought shares again higher. It's one of those ones where, okay, the stock market's working and you can kind of pyramid in. And I think that's what O'Neill uses, is the pyramid word. I call it scaling, because I say scaling because I will sometimes scale when it goes back down. And I think this is the flip side to what you're saying is, if the M in CANSLIM, which is the market, if the market is healthy and we're not seeing distribution days and we're not getting beat up or we're not churning, if a stock does go down, but I truly believe in my due diligence of what I did on the company, and it does go down maybe 8-10%, I'll buy more shares at that point. I know that's against all the CANSLIM rules, and I know that's a dangerous way to go. I think if you follow like a Mark Minervini, that's an absolute no-no. Don't do that. That could ruin you there. But because my position size, I size everything in a unique way where it's not going to blow up my portfolio. Okay, if I get hurt and I make a mistake, that one blow up of a 3 or 4 or 5% position isn't going to hurt me, especially if I have a couple stocks that are now up 200, 300, 400%. Coming out of a year like 2020, when you have, almost 10 of them that went up over 200%. It's okay to have a couple failures because you had so many huge winners, and you don't normally get that. So in today's market, what we're seeing, you're looking at this chart on the screen at Roku, I would cut my losses a little bit quicker. And I've been trimming some stocks. So I trimmed some of my best holdings, some of my highest conviction stocks, Square, Pinterest, and Roku. I trimmed them because I felt the positions were a little bit larger than the risk that I'm seeing in the market right now. And I can always buy them back in. And people are like, well, what about the tax implications? Yes, they're there. What if they drop another 30%?
Right.
That's the if. And now if they don't, okay, well, now I'm gonna get banged up with some taxes. It's just the risk reward that makes me comfortable. And we've read this in books. What makes you sleep comfortable at night? And for me, it's the position size. So most of my positions are anywhere from 3% to 10%. If they get up over 10%, I start to trim at that point. Even if it's a great stock, I'm not comfortable with stocks that are super volatile, like growth stocks. If you look at my overall liquid assets, I have more than one portfolio. The other one's more of the longer term growth portfolio. And I've been starting to share this because when you posted your question up and when I did my last interview and I've been talking about it, more and more people seem to be much more interested in that portfolio. I don't talk about it because sometimes I can go a full year without doing anything in the portfolio. And they say, well, what do you own in that? It's simply FANG stocks and some old school, we use their products and services every day. I did a blog post back in 2014, and I actually termed it, "My wife's mutual fund does better than Wall Street." Right. And really what that was is what I started to realize at that point, it was the Peter Lynch way of thinking is buy stocks in the products and services of the things you use every day. And am I using Apple? Yeah, I've got 10 of these devices around my house. Why wouldn't I own the stock? Am I using Amazon? Every day I got a Prime box coming to the house, if not 10 of them. So I should own Amazon. Costco, I've been a member since 2001. I've been paying that recurrent subscription fee every single year, and we're spending thousands of dollars at Costco every year. Why wouldn't I own Costco? So it wasn't until 2014. So you got to figure at that point, I'm 35 years old roughly at that point. I'm like, maybe I should do some buy and hold, because I think if I look back at my portfolio the last 10 years, had I did some buying and holding, I think my overall net worth would be a lot higher at this point. So I said to my wife, let's just start buying stocks in things that we just know, things that we use, things that we know. And I still fumble. Chewy is one. It's a newer stock. It's a growth stock, but we got a COVID dog back in June. We signed up for the dog early in the year, and we got him in June, and all this Chewy stuff started coming to the house. And I have to be honest, I really hadn't heard of Chewy prior to that. And I said, Chewy. I'm like, we're getting all these boxes. I'm like, what is this? So I start to look into it. I see they're a public company. They were trading at $45 a share at the time, June last year. And I'm actually, I'll pull it up right now. And so we're looking at right here, June of last year, it's trading here. So I'm like, maybe I should go buy this stock. Now, it had just run up from 20, so it had doubled. So this is where a bias kind of hits you sometimes. I'm like, it's already doubled. I'll let it pull back, and then I'll buy. Again, making that mistake. Oftentimes as humans, we make the same mistakes over and over. Right. I should have just bought a third of a position. I didn't. As you can see, the stock ran up over 100. Now it's correcting. So now it's almost back near the 200-day moving average. I most certainly will grab shares here. Now, maybe it's overvalued, and there's arguments whether this is going to work, it's not going to work, but the funds are going up. It looks like it's ultimately going to trend towards some profitability versus some of the pet companies of yesteryear, and sales are great. When I started posting stuff about Chewy, people started putting pictures up of their apartment buildings all around the country saying, yeah, there's more Chewy boxes than Amazon boxes. Yeah. And that was like, ding, 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 ding. I should buy this. So going back to that term account, and actually I'm going to pull this up and I'll probably publish this. I'm not really going to cover this account too much on Twitter just because it doesn't really move much, but just to give you an idea, and I think I have these sorted by yield right now. I do have it sorted by yield. AT&T and Verizon, I own them just because of the yield. I mean, one is up near 7%, one's over 5%. But CVS, J&J, Procter & Gamble, Home Depot, JP Morgan's actually a new ad last year. I actually dropped ExxonMobil, picked up JP Morgan, and Pepsi was another one I dropped as well at the time. And now recently I actually added Teladoc to this. Teladoc's the only really true growth stock in this portfolio. I just wanted more Teladoc. I truly just believe in it. I could be completely wrong on Teladoc, and it's in both portfolios now. It's the only stock in both portfolios, but we'll see where that goes. But Netflix, Google, Facebook, Disney, I've accumulated most of this over the last 5 years or so. So really starting in 2014, the summer 2014, when I started writing about it, I just said to my wife, let's just start buying stuff in the companies that we use the most. And let's just hold it and let's not trade it. And so most of the companies you see on the list I've bought within the last 5 years. A couple of these go back a little bit earlier, like Visa is one. Visa is probably my longest holding of any stock. I love the stock. It's done really well, but it upsets me because I sold my MasterCard holding to buy Visa 10 years ago. And MasterCard has far outperformed Visa. And silly, I should have just owned them both. And that's why I own Fastly and Cloudflare now, because sometimes I have that theory of maybe just own both of them, because who's really going to be the ultimate winner?
Right.
This account is long-term. And if I broke down my overall just liquid net worth, put real estate or anything aside, I've got my growth account here, which is really a FANG account, and then some blue chip stocks. Now, 14 of these stocks do pay a dividend. But at the end of the day, if you take the overall size of the account, it's really only about a 1.5% payout at the end of the year. So it's not a dividend account. I don't want anyone to get confused that I have a dividend account. It's just that's just extra, something on top. And this account's in an IRA, so it's a non-taxable account. So all the dividends automatically reinvest in the stocks. I actually set that up. It's a set-in usually with most providers. They can say, if I get a dividend, can it just automatically reinvest into the stock? That's what we do. I don't take the dividends. They just automatically reinvest. This is really a portfolio I'd love to hand to my kids one day. I mean, we'll make some subtle changes here and there. I used to own Coach, Michael Kors, other companies that we were buying a lot of stuff in. We thought to buy them and they didn't work out as well, those stocks. So we decided to cut them, added Microsoft. As I mentioned, JP Morgan, we added. What else? Disney is actually a recent add within the last year. Just stocks that I thought would make a lot of sense for me and my family. What are the kids using? What are the kids buying? Or what are we buying for them? What am I using? What's my wife using? Let's just own those companies. Keep them to a basket of roughly 20, 25 stocks at any given time, and then just kind of hold them. If this list right here looks exactly the same 1 year from today, I wouldn't be surprised if I've made no changes to it. So I don't talk about it much just because it's a stagnant portfolio. I don't do much. And when I write my annual list, I do say, guys, you should own the FANG stocks. Everyone should own them somewhere in a retirement account. And that's what I own it in a retirement account. So I can let this increase in value over time without tax implications. And then when the time comes, if we need the money or we want to pass it along, well, that will be 20 years from now. And I'm sure some of these names will change over the years. I think like a JP Morgan, maybe that's a ride a little bit more short term. But if another stock that's more of a growth stock today becomes one of these great blue chip stocks in the future, I'll rotate something in and out of the portfolio, or just add it if I have extra cash. But I don't cover that much. So I've got the growth portfolio. I have this portfolio. I know we're not going to talk about it today, but I have crypto. We have company stock. So my wife works for a company that allocates the stocks. We have a pretty substantial amount of company stock. And then I have an index fund account with Vanguard. And that's truly for the kids, whether it's an education account or it's just for them after they get out of college. It's just say, hey, guys, you can either keep contributing to this or it's your money. Do what you want with it at that point. So ultimately, I'd love to give this account and the index funds to my children one day in the future and just say it's yours. I don't need it. And that's the goal at this point. So
awesome.
I'd say this account probably is roughly 35 or 40% of my invested net worth, not my overall net worth. And then the growth account was up near 30%. It's probably back near 25 after my drawdown. So this is roughly 40%. That's probably 25 to 30%. And then the other guys are like 15, 10, 10. And that rounds out all my investment funds. And then you have my income, my wife's income. These are really to accumulate wealth. And then we have investable real estate. But I think one thing I don't know if we really want to get into this too much here, but triple net properties is something I really want to accumulate over the next 20 years. And a triple net property is essentially a property that I could buy or anyone could buy out there that has a piece of land that has a building on it that usually is rented by a big franchise company. Dunkin' Donuts, Starbucks, Burger King, Wendy's, whatever. A lot of the quick serve food service industry type folks. McDonald's owns their land, but just about every other company out there leases all of their properties. What a triple net lease does, it says, is that the leasee, not the leaseor, they're going to lease that space and they're responsible for everything. They're responsible for the lease payment to me as the landlord if I own it. They're responsible for the property taxes. They're responsible for the property insurance. And then they're responsible for the full maintenance of the property itself as well. If you have a leak in the roof, good luck, guys. That's your problem. That's not my problem as a landlord. Your pavement's breaking, you got to repave the parking lot. That's your problem, because in a triple net lease, it dictates that the person that's leasing the property is responsible for everything. Now, the trade-off there is your return's a little bit less because now they're responsible for the other stuff, but you're getting a grade A tenant into the space. So if you buy a piece of property, say in Ohio, and I'm just picking Ohio because here in Jersey, they're much more expensive, and it's $1 million. And you're going to finance it, of course, unless you have $1 million cash. And you buy that piece of property and Dunkin' Donuts wants to take the property, and the franchisor actually guarantees that if the franchisee goes out of business, they'll plug someone else in. So you know, as a landlord, you're going to keep getting paid regardless if that franchisee actually goes out of business or not. But hopefully you do due diligence and you have a good site that maybe it's an existing business that someone's selling the property and the Dunkin' Donuts has already been there for 20 years. You buy that business, you usually make anywhere from 4 to 7% on return of your purchase price on an annual basis. So if you buy a piece of property for $1 million and you're making, say, 5%, that's 5% cash flow that's now in your pocket. So that's $50,000 in cash flow for that property. If you owned it free and clear, that's now minus if you took a mortgage out.
Right.
The goal for me and my wife right now is to buy one of these properties every 3 to 5 years for the next 20 years. And hopefully when I get into retirement, we can have cash flow between $20,000 and $40,000 a month of just our properties. And then we won't have to worry about a 401k, pension, retirement, our stock accounts. And that would really be what we live off of at that point. So that's my goal. I wish I learned about triple net properties 10 years ago and started investing. I don't own one yet. I started looking into them about 2 years ago. COVID hit, so we pumped the brakes. But I think there's going to be a lot of vulnerable properties coming out of COVID. I think there's going to be a lot of opportunities around the country. So I've been working with a few brokers that you get the large lead list around the country of usually anywhere from 1,000 to 1,500 properties that would allow you to kind of accumulate wealth that way. So I look at that as cash flow as well. So I look at the long-term growth account the long-term account and the growth account is just accumulating wealth, but not providing me any income. Although there's some dividend paying stocks, I'm not making a lot of income from that. I want income coming from other places. And again, that goes back to me not being a full-time trader. I think cash flow is king, and I want multiple streams of income coming into me between myself, my wife, and our other investments outside of just the stock market. Makes sense.
And real estate is something that I've been trying to learn a little bit about. So it's interesting to hear you talk about it. It's not really a focus right now for me. I'm really trying to focus on, I guess, mastering stocks first, but definitely something I want to branch into later. Going back to position management, I think is something that a lot of people had questions about on Twitter. And recently you said you've been trimming stocks because they're getting a little bit extended and the market's a little bit vulnerable. So can you talk about a few things? I guess first, how you view the market conditions and how you judge that. You mentioned kind of clusters of distribution days earlier, which I think is something that's very important to pick up on. But also in general, how do you manage a position, whether it's breaking key moving averages, how you decide when to trim or sell it outright is something that I think a lot of people are very interested in.
Definitely. So from an individual stock perspective, if the story starts to change, and that's really from a sales and EPS standpoint, and technically, if you're starting to see a breakdown key moving averages, so if it's already sliced the 50-day, if it's getting vulnerable near a 200-day, and obviously if a stock gets down to the 200-day, you've already lost a big portion from the high at that point. Typically, the stock's already down over 20% from its high if it's at the 200-day, if you were in a growth stock. But if the story starts to change, if you see a competitor coming into the business and you think they're going to chip away at what this company's been doing really well, maybe for a period of time, that's probably the time you want to start to trim a little bit or just bail and get out altogether. I make mistakes. I Stone Company, STNE was a company I thought I had a lot of conviction in. I owned it. I've actually bought and sold it multiple times. And when the pandemic hit last year, I thought in South America, they'd get hit really hard in Brazil. And I thought their revenues and their company would get hit really hard. I basically sold at the bottom near like $21 a share, and the stock ran to over $90 a share. and I made a mistake. So sometimes you make the mistakes and you try to guess what you think is going to happen. And a lot of what we do is speculation. We're trying to see the future and buy these stocks now for what's going to take place in the future. So number one is story. But you have to back that up with numbers. You can't just say, oh, I just believe this company is not going to do as well because that's what I believe. Zoom is a good example. A lot of people think maybe it's not going to do as well, but let the charts and let the numbers actually show you that. Let it confirm and give you the true signals that, all right, this story has probably changed. Maybe you should get out of this. And again, I'll say this again on the podcast, I'm not saying for people to get out of Zoom, but I'm just using an example.
Right.
That's number one is the story. Number two is the market. And I just brought up the NASDAQ chart. When you start to see distribution days over and over in a market, you know something's changing. And when you have the market that it's so much higher than its own 200-day moving average, it's probably a little extended. Why wants to pull back a little bit. And then when you see it happen and slice the 50-day, that's another indicator to say, hey, maybe I should start to lighten up on some of my weaker positions at this point that are maybe also doing the same thing. They're also having their own individual distribution days, and they're also slicing support levels and or moving averages. A lagging indicator that I use, and it is lagging because by the time this indicator kicks in, most stocks have come down 20, 30, 40%, are the number of new lows versus the number of new highs. So when the market is running really strong, your new highs are hitting new peaks and your new lows are very low. But when that reverses, it takes a lot for a stock to go from a new high to a new low. So normally it's going to correct a pretty significant amount by the time a bunch of stocks start hitting new lows. But you always have stocks that are leading the trend that will get there first. So you have 25%, 25%, 20. It's kind of that bell curve of where the stocks are all sitting. Once the new lows start to really pile up, or at least we go from a net positive new high, new low ratio to a net negative, that's where you want to start to lighten up as well, or maybe consider trimming your weakest holdings. If you have conviction on holding some stuff longer term, then you stick with those stocks. I feel my portfolio is probably best between maybe 10 and 12 stocks. I've been up near 15 to 18 most of the past 6-8 months. I'm down to 15 right now. I probably should still go down to probably closer to 10 to 12. Right now is the time to do it. I've been trimming some stocks, and it's not something where I just hit a switch and just trim everything on all one given day. But I think if you're going into strength and you're seeing reversals in the market and you get an opportunity to sell a little bit higher one day versus maybe the prior week, well, that's your opportunity to get out of that stock if you weren't feeling so good about it. When a stock is going down and the market's getting hit hard and you're thinking in your mind, geez, I just really want to get out of this stock and that stock. The minute those stocks bounce up in the subsequent day, just get out. Get out of the stocks quickly. It's giving you an opportunity to kind of get a little bit of your capital back and just get out and clear your head at that point in time. So I think when the story changes, when the market's showing you distribution days, and when the new high, new low ratio is starting to kind of switch a little bit. And then that last indicator, it's not really a lagging indicator, but it's more of a macro indicator, is percentage of stocks above the 50-day and percentage of stocks above the 200-day moving average. Those are key. And that's it. I don't really go much further than that. I don't dive into price earnings ratios. I don't dive into a lot of the other, I guess, fundamental indicators that some other people maybe use on a more fundamental analyst type level. I keep it just with sales, earnings, and then a couple of these indicators I just mentioned.
Very cool. Very cool. And tell me a little bit about your mindset. I guess the past few weeks are a great example where your entire, because not just one growth stock is getting hit when they all get hit. They all get taken to the cleaners a little bit. So what's your mindset when your entire portfolios, probably a bunch of people watching this are in a similar position where a lot of them are down 10, 20%, maybe at the least from the highs from where they were. So what's your mindset during that, during when that happens? And are there any tricks or maybe hedging strategies that you've employed to try to lessen that blow and kind of flatten that equity curve a little bit during those drawdowns?
Definitely. So my number one trick is just kind of moving some stuff to cash and having some cash on hand. I'm usually never fully invested. I might get the cash levels down to about 5% in that growth account. They don't get much lower than that, and I don't use leverage. So I think from a psychological standpoint, I can sleep well at night because I'm not using leverage to kind of lever things up. I figure I'm already in a growth portfolio to begin with, so it's already leveraged just because of the types of stocks I own that can run real quickly, both up and down. If I leverage that, yes, on the upside, year of 2020, you can make an enormous amount of money, but then you get into a market like we just had. If you're leveraged, I mean, if most people non-leveraged are down 25%, people that are leveraged are down 50%. And if you're very pinpointed in your portfolio and you have a lot of similar stocks, position sizing helps you on individual stocks if one gets hit. But when the whole market gets dinged, that whole portfolio is coming down. So yes, my portfolio has been down over 20%. So I know there's some canceling people say, well, that's just silly. Your portfolio should never come down 20%. But it did last March. It did back in 2016. I mean, maybe it wasn't quite as large, the dip, but back in 2007 and 2008, I've gone through these before and they've always come back. If you're really in really good companies and you do your due diligence properly, they will come back eventually. It's just going to take you a little bit longer. If I hear someone that consistently says they kind of hit the top and buy the bottom, I mean, I don't always believe that. Certainly there's some folks out there that probably do it better than others where they're close to the top and close to the bottom, but that's not my style. I'm not going to get the top.
Right.
I'm not going to get the bottom. I'm really looking for the overall trend. And what we see right now in the NASDAQ is we're obviously trending down. If you look at today, I mean, is that showing a red candle for today?
Yeah, I think it might have been down, at least the composite versus the QQQ, but it tried to venture towards the 50 SMA, but got rejected once again.
Oh yeah, look at that. So yeah, it's getting rejected right here by the 50-day moving average. Yeah, I thought it was actually up slightly today, but it looks like it is a red day. So volume was actually lower. Looks like it was a down day for today. If it struggles getting back above that 50-day moving average, that's just another signal with the distribution days and with the churning of former leaders that this market might have another leg lower.
Right.
The key thing is going to be, though, does it undercut that pivot reversal day? That really is the key to me. And what I do with my style, I know you're very similar, and there's a number of other folks that are very similar to us on Twitter that kind of look at that same thing. If we don't undercut this pivot reversal day, I think we're okay if we just base and kind of trade sideways for a little bit, and we'll eventually have to kind of reset up and get another pivot reversal, another follow through, or the initial follow through. But if we don't undercut this and we do get a follow through day between now and say middle of next week, then I think we're okay. We'll start to move forward. Ultimately, it can be a false breakout. But we just got to look at that at this point to see what's going to happen. But those are some of the signals that I look at. I'm a discretionary trader at the end of the day. I'm not a systems trader. I don't have a system that tells me buy here, sell here. I'm kind of just taking these indicators from a discretionary standpoint and kind of plugging them into my own head, not a computer. Say, these are the levels I'm looking at. These are the things I'm looking at. These are the decisions I should make when these things happen. I do get alerts on my phone, and I set up all the positions I have to have certain alerts to send me a text message should something break below where I think it's a point where maybe I need to sell or trim a stock. Same thing on the upside. If it's something that I'm watching that, hey, if it gets above this, I want to buy it. So send me an alert. I don't put automatic buy or sell orders into the market, but I do get things sent to me, and then I'll just sign in and I'll make the trade at that point if I want to make the trade at that point. If I go away on vacation, and I went on a ski trip recently, I did have my phone with me for the most part, but I don't really even put in sell orders there as well. I kind of just like to look at it and make manual trades. I've been whipsawed too much throughout my career in these investments where I've been in some stocks and I've gotten sold out of them. And before I know it, they're up 20, 30% again, and they've left without me. And then before you know it, after that, now they're up 100%. And you're like, damn it, I was in that stock. I had it. I took an 8% loss, but now it's up 80%. And I missed the entire run because it just got ahead of me and I just couldn't grab it, and the risk reward wasn't there anymore. So that goes back to sometimes I'll take those larger intermediate losses where I won't, or drawdowns, I should say, where something goes down 10, 15, 20%. I'll sit in them because I don't want to get whipsawed out of it, and I do believe it's going to recover. This particular market we're in right now, I want to see what it does. And I've been talking about this on my Twitter is I don't know where it's going. I don't want to form an opinion. I want it to tell me where it's going. So either give me a follow through or give me an undercut. And the third option is trade sideways for a little bit and let's try to reset up some other way. So until it tells me what it's going to do, I'm not really going to make other major moves inside the portfolio, because I go down my list every week and I look at the companies I own and say, do I truly believe in this stock, in this company? And just about everything I own right now, I still believe in it long term. Right. And when I say long term, years. So I don't want to just sell it just for the sake of selling it. If we do undercut, I do have a short list. I'm not going to say it here because I don't want to just have other people making decisions based off what I say. I have a short list of stocks I'll probably sell. Now, when I sell them, I'll let people know if I sell them, but I have a short list of the 15 stocks I own of 5 or 6. I say, these are the first ones to go. If A, the market break undercuts, and B, they start to undercut where maybe I don't want them to be anymore.
And I guess you're grading that based on your conviction and maybe also the price and volume characteristics that how strong they are during this most recent drawdown.
100%. It has a lot to do with that. And of course, a few of the holdings I have are beat up tremendously. The relative strength on a couple of my stocks are terrible. They're under 10 at this point. But it goes back to that story as well. Do I believe Teladoc being one of my largest positions now across 2 different portfolios? I have tremendous conviction in that stock, but it might fail. I could be wrong. I mean, that's the thing with trading is you ultimately always could be wrong. And I think over the course of your career, you're probably going to be wrong more times than you're right. It's just you really have to capitalize on those times. Like last year, when you get into a couple stocks, you are right and they go up 400 or 500%. Those are the types of runs when you can actually, and that was part of the reason I sold Trade Desk. I had such a big gain in that stock. I wanted to just realize it at that point. And now if I have 3 or 4 losses here that are 5%, 10%, it's going to be nothing compared to that almost 400% gain I had in Trade Desk at that point. It's going to take care of all those losses. So the fact that I had so many large gainers last year, I have some leeway this year in 2021. But if the market keeps telling me it wants to go lower and we want to go more into a bear market, and again, I'm not saying we are, but if it gives me those signals, I will sell. Will I go to 100% cash? Probably not, but I definitely would go to 50% cash. You mentioned hedging. I've tried to employ certain hedging techniques in the past, whether it's selling calls, selling puts, obviously going to cash. I think we're all aware Puru has a great account on Twitter, and him and I used to be fairly close at one point. We talked a lot privately, and he kind of explained to me how he used to short the IWO, which is somewhat closely aligned to growth stocks. And I think he learned that from Tom Basso, if I'm not mistaken. And I did use that a little bit last year, and it was after I learned it from him first and kind of went into Basso and what he taught just to see what I could read on the internet as far as what that hedging strategy was. I think it works, but it whipsawed me around a little bit, and I felt like I lost money using it. So it's definitely something that's still in the toolbox. I don't know if I'll use it a lot. It's not my tool, but it's something that I've seen another impressive trader out there, especially with Tom Basso, if it came from him initially. I mean, a really impressive trader use it and say it works, and it kind of helps you hedge on the downside. I think 2020 was unique because we had some drawdowns, but then quickly we're right back up, and that's what whipsaw that hedge out, and it didn't work for me, and I lost money pretty much each time I put that hedge on. But that's the point of the hedge. The hedge is there to protect you just in case it doesn't bounce back up. This particular market, the hedge hasn't triggered yet, but it's pretty damn close, and it is something I definitely would look at. You could always buy the inverse Qs, inverse other index type stocks. I've used them occasionally a little bit in the future, but cash is really my main hedge. I like to just go to cash a little bit. But for folks that don't want to go to cash, I think you have to look at options or some of the inverse type stuff to use and hedge yourself against your portfolio.
All right, Chris, thanks so much for sharing all those interesting tips and kind of details about your strategy and methods. I always like to end it with this kind of one last question. What kind of tips do you have for new traders who are maybe just starting out to kind of accelerate that learning curve?
Sure. So 2 things I would say to any new traders out there and kind of just looking what I went through is 1, educate yourself. And there's a lot of great resources, a lot of great books. I think the fact that social media is out there, you can learn a lot, but just make sure you understand who you're following and what you're following. If someone like me or another account that maybe has a lot of followers says, hey, I bought XYZ or I sold XYZ, you have to understand, A, why did they buy it? Why did they sell it? What is their time frame? What I'm doing, what someone else is doing, it could be completely different for a million different reasons. And me buying a stock or selling a stock might be right for what I'm doing, but not right for someone else. And I think you just need to educate yourself with a lot of the books that are out there to understand what's the method that you want to do. Do you want to day trade? Do you want to swing trade? Do you want to position trade, trend trade, long-term trade? Do you want to buy dividend stocks? I think you just have to ultimately understand a self-awareness of what worked for you mentally and what are you most comfortable with as a trader, and then start to kind of trade towards that. And the second key point is put money towards it. Don't trade a paper account. I mean, I've heard that a lot. Say, oh, open up a fake account, just trade. You don't get that true heart and emotion that's involved in stock when you have true money on the line. So even if it's only $500, and I'm saying if you're a 18-year-old kid, I mean, now kids are even younger than that, trade on Robinhood. If you're a kid that's out there, get $500, get $1,000, and just start trading, and then start to jot things down. Understand. I do have a journal. I could do a lot better with it than the notes I actually keep in the journal, but write down, why did you buy it? Write down when you bought it at X, where you thought it was going to go and why you thought it was going to do that. And then see what actually happens. And then when you get out of the position, did you make money? Did you lose money? Why did you make money? Why did you lose money? And start to kind of jot that stuff down. Over time, if you start to look at your journal, you'll start to actually pinpoint where you do really well and maybe where you're making the same mistake over and over. And don't look at other people's journals. You have to look at your own, because it's the only way you can really understand it. So my best advice to a young trader is just get out there and just do it. Just put some money into the market and start to learn what works really well for you. And ultimately over time, and that's the other thing, be patient. It's going to take time. It's like any other profession that's out there. And this is not my profession, but it's something I've done for a really long time. You can't teach experience. Experience just comes by doing. So just do it, and you will get the experience, and you'll look back every 5 years or so and say, wow, I am so much smarter and better than what I was 5 years ago. And you'll keep saying that every 5 years. Every 5 years, you just get smarter and smarter. And as long as you take those lessons learned and you implement the lessons from those learning experiences, you will get better. And ultimately, your account will start to grow over time. And then when you get to my age, you'll be like, wow, the last 20 years, amazing how far I've come. And just think about how far you can go in the next 20 years. So that's the best advice I can give to young traders, is just go out there and just do it.
Awesome, Chris. That's great. And I'll have your links to your Twitter down below and your website. But is there any other places that you think people should reach out to you and connect with you if they want to know more about your system and your methods?
Yeah, I think Twitter and the website. The website I don't write on too much these days, but I think you ultimately start with Twitter, and I try to get as engaging as possible with most folks on Twitter. I think as the number of questions, the number of comments that come in over time, as a audience starts to grow, it's when I had 5,000 followers versus what I have now. I mean, it's tough to respond to everything, but I try to do my best. So I would say to anyone that's out there, if I don't comment back on one of your comments, don't take it as a slight. It's just there's so many of them coming in, I can't get to everything, but I do try to get to as much as possible. So if I miss you once or twice, keep hitting me up, and I'll try to answer your questions, and we'll go from there. I think it's a great spot to kind of learn from folks and things that you're doing with these YouTube podcasts. And I think it's awesome what's going on with FinTwit these days.
Yeah, no, I completely agree. It definitely speeds up the learning curve for anybody, I think, who follows the right people. And I think it was a good point what you said previously. You want to follow people similar to your style and what you want to do and achieve, because our style is a little bit different. Your longer term time frame, I can definitely learn from you and take pieces of your process. But most of the people I follow are similar styles to me, a little bit faster term, looking for the swing trades a little bit. And it's good to stick with your style, because otherwise, at the end of the day, it's a little bit of noise, and you want to be focused on yourself and your trading and just improve that as much as you can.
Yeah, and it's a really good point, Rich, that you bring up. And recently, there's people that I follow, and I won't put out there, it's no slight to anyone. I've muted some people recently, just because, to your point, we're in a time in the market where you have to be very diligent about what you're doing, and
Right.
the market could turn very quickly here. And my time frames and their time frames are different, so they might be out there talking about one thing that doesn't align with what I'm trying to kind of figure out right now. So I have to turn them off. And I think others have to do the same thing. And you just have to know, where you're at, where they're at. It's not that I'm right, they're wrong, or they're right, I'm wrong. We both could be right, or we both could be wrong. It's just, we're just doing something different. And I think, as you know, in the market, there's a million ways to slice this cat. There's a million different ways to make money in the market. Not one particular way is right. And I know my way is not right for everybody. I mean, it's just a small niche of the market that do what I do. And I know there's a million other ways where you can make a lot of money in the market doing other things. But ultimately, I think some of the fundamentals, like you say, I mean, CANSLIM is something we certainly share. So there's a lot that we share at the root or the foundation of what we do. So I think that's important. So definitely broaden your horizons, and you always want to see what other people are doing a little bit differently than what you're doing. But focus on what you're doing, especially in turbulent times. I think that's very important to kind of keep your head clear and kind of tune out some of that noise. And it's only noise because it's not what you're trying to accomplish.
Awesome. Yeah. I guess we'll end it there. For everybody watching, thanks for tuning in. Remember to leave a like down below and subscribe if you're new to the channel. And we'll see you guys in future videos.
Thank you.